Good morning, everybody. Mike Vacchi, PrincetonTrader.com, here for NTMarkets.com with your Wednesday morning pre-market webcast. Okay, daily chart of the E-mini, and what I was talking about to my subscribers yesterday, I did a little webcast on our audio yesterday morning. We talked about how we were in the midst of a 3-day battle over the mid band. It would appear, at least for now, that 3-day battle for the mid band has been won by the bears. So as we look at yesterday, we had a push down into the 48 area, and the bulls bounced it from there. Tried to take back later in the day the monthly pivot up at 63.83. We actually put out a short setup with a risk marker up at 64 that was a decent trade, but we got stopped out in the chop overnight, and then we had the big drop. As we head into today, there's a couple dynamics that I'm looking at. If you're the bears, what you really want to do down here is just kind of hold, serve, maybe push down a little bit farther. Ideally, get below the red line there, which is the 50-day exponential moving average. That's down at 37, 37.44, basically 37.5, and avoid the big move higher. The tendency for the bears is to try to do these great big moves, and the dip buyers come in and wait, and then they rip things higher. That's how you went from 48 into the 60s yesterday. That's how you did 15 handles up off those lows. Ideally for the bears, you'd like to see them keep price under 50, under 20.50, and try to close somewhere in the area of the 50-day. You can see the lower Bollinger Band there, and there's no reason why we could not go on a lower Bollinger Band ride. And I am fully expecting that we would get a touch of the lower Bollinger Band. The mini is always like to trade from band to band. Upper band, middle band, lower band, middle band, upper band. Lower band is just the next thing. Whether price can extend from there and do a band ride, remains to be seen. So, the task today is pretty simple. Bears need to defend what they've gained in the overnight session. They have to avoid the ripper. If they do end up in the middle of a ripper, they're going to have to step in and make that yet another lower high, which is what they ended up doing yesterday, and then go make a lower low. Their reaction to the move up to the monthly pivot yesterday was perfect. You're going to get, especially if we're going to start, kind of a downtrending market in the very short term, you're going to get violent rallies. I think that's what we had yesterday. Those violent rallies are sells, and they should create lower lows, and that was the result of what happened yesterday afternoon into this morning. If you're the bulls, you're not going to be scared away all that easily. You've been buying dips forever, and they tend to work. The bulls will come in and try to rally the market today. What the bulls want to do is get a bounce going, create higher lows off that bounce, and come back and try to take back some of these levels that they've lost over the last few days. We've now pulled back. We have pulled back basically 62 handles, 60 plus handles from the highs of a couple weeks ago up at 2105. So, anybody that was saying the market was overbought and we go up every day, I don't think that's really the case anymore. The Bollinger Bandwidth is still very tight at 3.8. It was 3.6 yesterday morning, and you can see that lower band kind of starting to try to expand. So the bulls, need to get one of those rallies started and then start turning key areas back into support, which they weren't able to do yesterday afternoon into this morning. So the pressure's on the bears, not so much to dump the market out. I think that's the wrong move on their part. They simply need to demonstrate that price wants to trade now in the 30s and the 40s versus wanting to trade in the 60s and the 70s. All right. Everybody have a fantastic day. Follow us at Twitter at Princeton Trader. Check out the website, princetontrader.com. Come check out the chat room. I'll be back tomorrow morning with another webcast. Trade 'em well, everybody.